The first model I published is the stock to flow model, and I guess that's where people know me from. That's Plan B is stock to flow, etc. So people are mentioning the stock to flow and are connecting everything I say to stock to flow. But in fact, I use three kinds of models, and stock to flow and the stock to flow cross asset model that came later. Those are what I call fundamental models. They try to on a fundamental level, not on a price level or based on something else, but based on some fundamental thing, scarcity in this case, say something about the value of Bitcoin. So stock to flow is the center, the core of all my modeling. That's true. But there are other models, and for example, the well-known technical analysis models, which are price driven. They're based on the Bitcoin price only. Maybe some volume data, but I don't use that. So for example, an RSI, a relative strength index, would be a technical indicator, or a moving average. So the 200-week moving average is something that I use a lot and tweet a lot about. And my favorite technical analysis thing is my floor model that got a lot of attention lately as well, because it nailed three of the last months to the dot. But it's a bit in trouble right now. We'll probably talk about that later. But that's a floor model, and the third kind of models that I use is on-chain models, and that's something very specific for Bitcoin, because Bitcoin has the blockchain and all the transactions are in there, so everybody can analyze all the transactions that and all the blocks that come in every 10 minutes, and see if it's big transactions or small transactions, old wallets selling or new wallets selling, and those kind of patterns are very, very interesting. It takes a big computer, it takes a lot of data analysis skills to do it, but it's very exciting. And I must say, I spent most of my time, maybe 80% of my time, in that on-chain data analysis area. So I'm an investor. I like models. I use all those three kinds of models. So a fundamental model, stock to flow, for example, the technical models and on-chain models. And I think that's where a bit of the confusion comes from sometimes. But that's how it is.
Do you believe that any of your modeling is influencing the behavior of market participants out there?
Nah, not really. By now I'm a pretty large account, but not large enough to move markets. In fact, I think I had more impact on the markets when markets were a bit smaller, like 2 years ago or something. But no, I think it's much more fundamental than just an opinion or a model that someone that the market follows. I think there is greed and fear in people. That's just human behavior, and that will always be there. So it's very interesting to see that people like to buy Bitcoin when Bitcoin is going up, although prices are, of course, a lot higher than when Bitcoin went down. But when Bitcoin goes down, nobody wants to buy Bitcoin. There's always greed and fear, and you can model that, right? You can model that, and also there is momentum in the markets. That's one of the basic thing in all markets, also equity markets, bond markets, etc. That once a trend starts, there is momentum in that it goes on, and that could be because there's a large buyer in the market that cannot buy the exposure they want in 1 day or 1 week, so they need multiple weeks or months to build the exposure, and once that gets going, then it will continue. And so the momentum is a very real thing in markets, which of course all the technical analysis is based, or a lot of technical analysis is based on. And then the really fundamental things for stocks, modeling the cash flows, the dividend flows is a very real thing for derivatives markets, for example, options, which is basically a volatility market. Modeling volatility is very real and very fundamental. It doesn't change.
So I wanted to turn now to the question of evaluation of these models, because Sest, and I remember one of our earlier conversations, you were saying, put in short terms, in simple terms, if Bitcoin is not over 100k by the end of this year, 2021, that you would then say, okay, that model is probably failed. Do you still hold that view, or has your view shifted here?
Yeah, and that's a bit of a short measure, or a bit of a simple measure, but yeah, I still hold that view. I think stock to flow is tracking very well since it was published in March 2019, when Bitcoin was below 4,000. So it tracked really well. It mainly predicted that the halving would trigger another, was not priced in and would trigger another bull run, which we saw. We're now sitting at a bit below 60, what is it, 57 or something thousand. So if you look at the charts, for example, this bot of Bitstein, which can be found on Twitter, it's the stock to flow multiple called S2F multiple, and it tracks the performance of the model on a daily basis. And you can see that it tracks very well, within most of the time within a 1 standard deviation band, and it went a little below the 1 standard deviation band into the 2 standard deviations band lately, but came back up from there, and we're now smack back in the 1 standard deviation band. So and going towards 100k. So yeah, I think it tracked well as advertised, and I'm very even I am a bit amazed by that, because the model should not work at all. In fact, right, the efficient market hypothesis, you cannot model the market. But I think the proof of the pudding, the real victory lap, or how do you call that, is when we cross that 100k barrier. I guess that's the thing, and I guess it's good to explain that when you read the article, when you see how the model is made, it's just a normal regression analysis. It's nothing spectacular, nothing exotic. It's very, very simple, one input variable. But what it basically says, it's after the 2020 halving, the price level should be on average for that halving period. So until 2024 should on average be $100,000. So that is the real proof or validation, if you will. If we track, if the data still fits that very simple linear regression, then it's all okay. But since technical analysis people somehow don't really understand the average linear regression thing, and are really used to think in levels and price targets, I shouldn't say dump that down, but I simplify that into if it should be 100k on average, then 1.5 year into the halving cycle, so 1.5 year after the last halving, it should at least cross that average of 100k, because otherwise it will be very difficult to be 100k on average. We should spend a lot of time above 100k to even make that average. So at some point we should cross that line, and I guess historically looking to last 2 bull runs, 2017 and 2013, that point is about 1.5 years after the halving. So that's how I came up with end of 2021 it should be above 100k, which is very short and snappy, and technical analysis people understand it. So it's really the average that I should be looking at, but the 100k is short and simple.